Alright buddy, so on my TikTok channel, I've been getting a lot of requests of people asking if they can get a video on liquidity, on what liquidity is and basically how I'm trading. So basically, before we get into the charts, liquidity is where resting orders lie. So if you go to anywhere, let's say you go to like a order book, so you can see right here, these big bubbles right here, this is all resting orders. Big institutions are waiting for price to hit that area, either to let it, if you're going in for a buy, to buy it up and break past that area, or to reject it and fake people out and go the opposite direction with it. So the market is run basically by institutions, big banks, big firms that have billions of dollars they play with every single day. And people like me and you, retail traders, we have no say in what happens in the market. So we have to have resources like this, or understand liquidity, to know where these orders are lying and to make sure we're not going to get faked out. Like, I don't know if you're ever on a trade and it hits your stop loss and it reverses right off. That's a liquidity sweep. And it's pretty easy to find liquidity. So how we find liquidity, I have an indicator that helps me. It's called trading sessions. You can just type it on indicators on TradingView. You turn this on and it basically gives you the sessions, New York session, Asian, and London session. And the importance of these sessions is that this is where the most volume is active, right? Of course, New York time, that's of the U.S. stock market, it's going to be the most volatile, where everything's moving. There's also pre-market, which is London session. And there's after-market hours, which is Asian session. These sessions do move, not as much as New York session, but they are key areas of liquidity. Big institutions place their orders right around the bottom and top of these areas. So if we look at, this is October 1st, delete all these lines right here. So again, what I like to do before I go into a trade, and what works for me, has been working really well, October, November, I mark out the highs of the previous New York session, which is that green area. Lows of New York session. The highs of Asian session. The lows of Asian session. The lows of London session right here. And the highs of London session are going to be right here. So basically you can mark out the highs and lows of just the green and the blue boxes. But London session does merge a little bit with New York session on this. So just make sure to mark out the top and bottom of that yellow area. So once we get into here, let's take this sessions off. And I'm on the 5-minute chart right here. So basically, you can play it this way. I like to trade it on the 15-minute chart. I know it's some people like the 1 minute, the 5 minute. I like just higher time frames. It gives me a better idea where price is going based on the other indicators I'm going to talk to you about. But starting off with liquidity, right? Price opens at 763, which is down here, and we pump up. And immediately we reject off this key area of liquidity. And this area of liquidity was exactly the high of Asian session. Right here, marks right here. As you can see, there is a wick. Boom. And then what happens after? Immediately fall off a cliff all the way down, and then look, another wick off of another key area of liquidity, right? Literally 5 points away. They pump up. And once we see more examples, I've already charted out everything, but highs of Asian, lows of Asian, highs of New York session. There's no need to mark out the lows because this doesn't even touch here. Highs of London are going to be all the way up here, and your lows of London are going to be right here. So we take it off. What's the first thing we do? Price immediately dumps all the way down and bounces off this key area of liquidity. When there's a line, there's a little wick right there, that's what we call it. There's a high chance that price is going to reverse off of it. And that's the high of New York session. And what happens immediately afterwards? We run down a little bit more, wick through all these, wick, pump up. This happens every single time, every single day. There's always some sort of rejection or continuation off of the key area of liquidity. Now you can't just use liquidity alone, because you're gonna have days like for example right here, right? Let's say I want to go long for whatever reason, because I see it's bounced off of this area of liquidity. I missed this bounce off of, and then it rejects. It continues to reject, and you go long, and who knows how much you lose, right? Because this is a big dump. There's gonna be other days too. Good continuation day. Rips through, and say like we go on the, this is October 8th. Say we go on the 1 minute time frame, right? To October 8th. Oh, I don't have the. Say we go on the 5 minute time frame. Okay. October 8th. Rips straight through. There's a wick, kind of bounce down. For whatever reason, if you short it, you're gonna lose. And if you're starting up, you're a beginner, you might think of this wick as a rejection. Now, the other two key things that you can use to help you identify where price is actually going is, of course, marking out your areas of liquidity, but also using what I like to use, the estimated moving averages, which is the EMAs, or your simple moving averages, which is your SMA. Whatever you want, but these are just basically estimated moving averages of, or the simple moving average of where price is going to go. You can just go on indicator and type in EMA, estimated moving average, and it's going to pop up. The biggest indicators that people like to use is the EMA 9 and the EMA 20. The smaller the number is, so like 9 compared to 20, the smaller the number is, the more reaction it's going to have to price in the current time. So there's a big dip, which is this orange line, the EMA 9 is going to have a bigger reaction than that green line, because the green line is a higher EMA. I lowered it on purpose to focus on my strategy, but the EMA 20 is one of the most broad, EMA 9 and EMA 20 are one of the most broad estimated moving averages you can use. And the purpose behind it is that it helps you identify. As you can see, if you have really bullish movement, you don't want to be taking shorts the whole day, maybe. Same thing, another one you can use is the MACD, moving average cross divergence, I believe is what it's called. Just to make sure. Moving average convergence divergence. This just is another indicator telling you how much a volume of buying or selling pressure there is down here. And these are just using more lines to help you indicate which direction the price wants to move in. Happens every single day, right? Clear dumping even before pre-market, right when market opens. Same thing here. So what you can do is you can use your areas of liquidity, your EMA lines, and your MACD to establish your daily bias. Do I want to be bullish or do I want to be bearish for that day? And we go to a random day, let's say the 16th. Alright. We'll mark out our highs of London, our lows of London. Our highs of Asian correlate very well with our lows of London. And then our lows of Asian session right here. And then our highs of New York session. And our lows of New York session. Okay. We zoom in on the chart. And what do we see initially? We see a lot of chop, a lot of chop, a lot of chop. This could be a winning day or it could be a losing day, whatever you think. Depends on where your stop is at. But basically how I like to trade is, if this is why I like the 15 minute. It's a little bit more easier to read. Here, I only trade the 15 minute. If the green line is below the orange line, so if the EMA 20 is below the EMA 9, I'm only going to be looking for longs. And if that ties closely to my MACD, which at the time it does, it's about, very choppy market, I want to go for longs and target that next area of liquidity. And you want to place your stop either below the previous area of liquidity or have a fixed stop of whatever you believe in or a previous candle. So say I want to go for a long, all these opportunities around here, tend to turn for a long and target the next area of liquidity right here. Boom. Go to the next day. Right, we're opening up. Clearly long, EMA lines, green line is below buy. So you want to take a buy position anywhere early on and target your next area of liquidity. 20th is the same thing. Clear bullish day. Clear bullish day. You can enter for a long anywhere around there. Now there's days like this where there's a little bit of chop, but you can easily still win. You open up, and as you can see, you're slowly starting to fall off a cliff here on the MACD. Your EMA lines are opening for a sell. When the green line is above, you want to be shorting the stock. You never want to go long. And what you can do is you can take a short off of next area of liquidity, off of an EMA line, off of your SMA line, whatever you believe in, and you want to target your next area of liquidity or below. And again, just the bigger time frames give you bigger pictures. You can see what the overall direction of the chart on that day wants to go in. And this will work on anything. If you don't want to trade NQ, you can trade ES. Right, say we go to ES and we go to the same day. It's opening down, it's opening down. And let's go to random day, let's go to 28th. Okay. We mark out our session highs for London, session lows for London, Asian highs, Asian lows. And this is not going to work every day either. Remember, every strategy has losing days. Let's say here on ES, green line is below, so you want to be entering buy positions. So you can take a buy position right off of here. Area of liquidity, any of these EMA lines, you want to place your stop again below the key area of liquidity. So about 10 points down here on ES. And as you can see, if you place it right below the key area of liquidity, this was marked out. This was not because of this wick. This is the low of Asian session right here. Place it below. Almost touches your stop, but from there it runs up. And you can take your TP wherever you want. You want to target this area of liquidity, or if it breaks past, whatever you want. So basically the overall purpose is, in order to have a profitable strategy, you gotta have something going for you. And for me, that's I mark out my areas of liquidity, and then from there I use my EMA lines and my MACD to determine whether I want to be taking longs or shorts that day. And you want to set your take profit at a key area of interest, as I explained in the book map. These are all key areas of interest where you see these big bubbles. And if you don't have a book map, I don't trade with the book map. You can still figure out where those key areas of buying or selling pressure is at simply by identifying the highs and lows of the previous sessions. These are where orders rest, and this is where price may want to reverse or continue. Most of the time, from what I do, I see a lot of bounces, a lot of reversals. And the reversals are also just much cleaner, much nicer. But whatever you do, just make sure you're going into the market with the plan, having your areas marked out, and knowing whether you want to be buying or selling that day. So if you have any questions, just put them in the comments below, and I'll make more videos about it and help you guys out. So yeah, talk to you guys soon.